Let us begin with a simple illustration of forecast and forecast error using a basketball example. So here we have three players, Mr. Reliable, center, and shooting guard, and we have their scores over the last 100 games. The distribution of their scores over the last 100 games is presented here. So on the y-axis, as you can see, we have the number of games, and on the x-axis, we have the number of points scored. Now, Mr. Reliable, being Mr. Reliable, scores 25 points every game. So the red bar, as you can see, is at 25, and the height of the bar is 100. The center, on the other hand, scores 25 points on 20 of the games, but then sometimes he scores more than 25 and sometimes he scores less than 25. But as you can see, for illustration purposes, this is a uniform distribution. So the expected value of this distribution is 25, which would be your forecast for the center. In the case of the shooting guard, again, you can see that there is a uniform distribution. The mean is 25, but sometimes he scores higher, sometimes he scores lower, sometimes as high as 38 points, and sometimes as low as 12 points. So here we have these three players. The forecast for all three players for the game that they are playing tonight is 25 points. However, the confidence that we have and the forecast is quite different. In the case of Mr. Reliable, we are very, very confident. In the case of the shooting guard, he has his good days and bad days. And so we would say that our forecast for the shooting guard is more risky. And so then we say, well, how much more risky is it? How often are you wrong? And to illustrate that, we would look at the deviation of the scores from 25. And so the difference from 25 is really a measure of risk or the deviation. And in the case of standard deviation, what we do is we calculate the deviation for each of the games, and then we just square it and add it up. That's the variance, and then we take the square root of that. Instead of taking the square of the deviation, you can also take the absolute value of the deviation, and that would be another measure of risk. Finally, note that this distribution is a symmetric distribution, but what if the distribution is a bit lopsided, such that you have a few observations on the very left that do not happen very often, but when they do, they are large and negative events, in which case you may want to quantify this risk, and this is the risk that is measured by value at risk, VAR, which is a measure which we will talk about in the course. It's also called tail risk, or in a recent book that got quite a bit of publicity, it's called a black swan event, as in a very rare event. This data is from Ibbetson's, and it provides historical performance of asset classes between 1926 and 2012, a period of 86 years. And the asset classes are treasury bills, which are loans to the US government of short maturity, less than 1 year. Investment in government bonds, which are loans to the US government of maturity between 20 and 30 years. Investment in a portfolio of large cap stocks, such as the S&P 500, and investments in a portfolio of small cap stocks, such as the Russell 2000 index. So if in 1926 your great grandfather invested $1 each in these four portfolios, what would be the value of the investment at the end of 2012? That is the exercise conducted here. Inflation has averaged 3%, geometric average of 3% over the last 86 years, which means that for $1, if your grandfather was able to purchase a basket of goods, say a loaf of bread, butter, and jam, today or at the end of 2012, to purchase the same basket of goods, you would need $13. So that's the loss in purchasing power, which is picked up by inflation, which is 3% per annum. If you had invested in treasury bills, your $1 would be $21 at an annual return of 3.5%, implying that it just beat inflation by 0.5% a year. A portfolio of government bonds would be worth $123, which is a return of 5.7%, and so on. So, a few observations. First, you can immediately see evidence of a risk premium. So if you rank the assets based on their perceived risk, you can see that the assets with the highest risk, which would be the stocks, in particular the small cap stocks, have provided the highest return, while asset classes of lower risk have provided lower returns. So the last 80 odd years of data is consistent with the existence of a risk premium or an extra return for taking on risk. The second observation is that if you want to build wealth over time, and wealth can be defined simply as an increase in purchasing power, then investing in the bond market is not going to make the cut. In particular, you have to invest at least a portion of your portfolio in the stock market. Here we have some additional data from the bond market between 1926 and 2011. Treasury bills and government bonds, as you know, are IOUs or loans made to the US government and therefore carry less risk. In addition to that, here we have a data on the performance from a portfolio of corporate bonds, which are loans given to credit-worthy corporations such as GE or IBM. Uh, and in addition to that, we have the performance of a portfolio of high-yield bonds. So these are bonds or loans taken by corporations with higher credit risk, such as, say, Sears Holding during the financial crisis. If you rank these four asset classes in terms of risk and compare their return, you would immediately see that the observed return over a period of 80 years is consistent with higher risk assets earning a risk premium. So the highest return is earned by high yield corporate bonds, followed by corporate bonds issued by more credit worthy corporations, followed by long maturity government bonds, followed by short maturity treasury bills. So, again, evidence from the bond market is consistent with the existence of a risk premium. This table presents a summary of risk and return between 1926 and 2012 for broad asset classes. And the evidence here is once again strongly consistent with the existence of a risk premium. As you can see, the highest returns are earned by small stocks followed by large stocks, but the highest risk is also observed in small stocks followed by large stocks, which suggests that asset classes that have the highest risk have historically earned a higher return over time. And this is really what makes the whole portfolio allocation problem fascinating.